We're getting started in 3, 2, 1. Hey, welcome. I'm Mitch Goldberg. You're watching my live stream. Thank you so much for joining me. Your time is very valuable, and it means a lot to me that you chose to spend some of it with me. I work hard every day to make this show a worthwhile show. It's your post-market show every Monday through Thursday at 4:30 p.m. live on YouTube, LinkedIn, and Facebook. It's called Be the Boss of Your Money. Be the boss of your money. You've got to treat your money like you're the boss. You've got to get your money to respect you. Not, when you're someone who just respects money and you look up to money and you just value money so much, you may be going down, the wrong path. Money has to respect you. There's a difference. It's a mindset, but there is a difference. I'm not saying to not respect somebody who's achieved a level of success. I'm not saying that by any stretch. I am saying that don't get caught up about the money. You get caught up about yourself, your success, about being a help to others, a service to others. That's you're going to get paid. If you don't create value for others, don't expect to create value for yourself. That's what I say. I'm an entrepreneur, so I live that mantra every day. Whether if you're an entrepreneur, if you're in some kind of sales position, consultant position, you know what I'm talking about. And we're going to talk about personal finance for people in sales who basically live on a commission check as opposed to people who earn a salary. I want the show to be everybody. So, I want the show to be for everybody. So listen up. I'm going to roll the quick intro. Today's big deal is the taper plus the Delta variant is wreaking havoc in your portfolio, and it's making a lot of investors do dumb things with their money. You've got to avoid that. Don't make crazy, hasty changes with your portfolio. Now is not the time for that. It's actually never the time for that. We're going to talk about why, what to look for, what I think could be done. So let's just roll the quick intro. We've got a really good show today. I'm very excited. Here we go. Okay, welcome back. I'm Mitch Goldberg. If you're just joining us, thank you so much. We're talking about the taper. We're talking about the Delta variant of COVID, what it's doing to the market, what it's doing to portfolios, and people are getting nuts about this stuff. And we can't let that happen. We can't let it happen. Listen, if people didn't react to things, I wouldn't have a job. I consider myself as much of a financial coach and, let's say, financial psychologist. I'm not saying I'm a psychologist, but there's a lot of psychology involved when you work with something as emotional as people's money. Do you agree? Do you think money is emotional? Okay. Money is something that we learn how to handle from day one. And sometimes you don't have great mentors. I, for one, believe that I did not have a great money mentor in my life, but that's okay. I am too old to blame anybody else for any problems I might have. You've got to just focus on you getting better and learning what works for you. Okay. So let's talk about a couple of things. While you're watching this, if you have any questions about personal finance or the subject matter that we're talking about right now, I want you to ask me in the comments. Just hit me up with your questions. I love hearing from you. It's the best part of the show. It really is. I just love it when we get into the banter and the back and forth. If you're watching the replay, certainly if you have any questions, hit me up in the comments and I will see those. And I can't wait to get back to you. I'm streaming to LinkedIn, YouTube, Facebook. Connect with me on any of those platforms. If you're reaching out to me on my personal Facebook page, let me know you're a watcher of this live stream, so at least I know where you're coming from and you're not just like a totally out of the blue person and I reject it, okay? LinkedIn, though, is my jam. I'm also on Instagram. That's at Instagram Mitch G at Insta Mitch G. It's pretty cool that I think it's really cool that I was able to get that Instagram handle, and I post the highlights of all of my live streams on Instagram. I also post the highlights on LinkedIn, Facebook, YouTube. But I just know some of you are only going to be on Instagram, some of you are only going to be on Facebook, some of you are only going to be, on LinkedIn, YouTube. So I just want to make sure I reach everybody, make sure I have a broad reach. Okay, so a couple of things to talk about, and what I want to do first is take a quick look at how things did in the market today. Okay, let's go here. All right, let me. I'm gonna open up another screen and give you how the market did today. U.S. markets. I'm gonna blow this up nice and big so you could see it on your smartphone. All right, here we go. We're gonna share the screen. Pop myself in the corner. Oh, wait, that's not the screen. That's the screen. There you go. Okay, so here we go. All right. By the way, if you are somebody I saw out last night, great to see you. I was at a commercial real estate of Long Island get together yesterday. It's an event that was just phenomenal. It was outdoors in the back of a country club. Beautiful night, incredible food, and just a great time. I saw friends that I haven't seen in literally 2 years, year and a half, 2 years, and it was great to get out and see so many familiar faces. And it's like it hits you like you see someone, you're like, man, I missed you so much. It is so great to see you. Luckily, the event was outdoors, uh, so I went. I am being very COVID careful, and wherever I go, I do bring a mask. This is the famous KN95 mask. Put this baby on when I am indoors. It's not a big deal, but the Delta is a serious thing, and I am definitely concerned about it, and I have a family, so I want to make sure we're all protected. We were all vaxxed, by the way, but I'm just going to be careful, and to each his own. Okay, so that somebody is out there, Jack. Jack, hey man, good to see you. Jack, it just occurred to me looking at your LinkedIn picture, you need to update your LinkedIn profile pic. Very easy to do. I'll walk you through it if you want, but you have lost a lot of weight, man. You look great. You also look a lot younger than you do in this pic. So, because of all the weight loss and how good of a shape you're in. So I think you need a new LinkedIn profile pic because you look so amazing now. Thank you so much for joining me, and I hope you are enjoying a good stogie outside, and hopefully it's not too humid for you. I was outside this afternoon. Oh my God, it is crazy humid. Not as humid as Florida. A lot of people go, "Oh, it's just like Florida." I know how Florida is. No, I've actually lived in Florida in the summertime. Believe me, what we have outside on Long Island is nothing compared to how bad it is in Florida. Okay, you're very welcome, my friend, and thank you for joining me. We got to get to lunch. We have to do lunch like outdoors before like the whole world goes into another lockdown, right? We got to get out there. We got to do it. All right, so let's go over a couple of things. So overall, didn't it look like the Dow was just going to tank today, and it was down about 350 pre-market trading? You're like, oh, we just fell off the cliff. The Dow is going to really tank, and we're all screwed, and that's the end of the world. By the end of the day, so the Dow is off 66 points, less than 0.2%. I don't know why it's skipping like that, but big deal, right? NASDAQ was up 15, went into the green. S&P was up a little bit. Not so bad. The VIX, though, okay, the VIX right here, still 21, okay, still above 20. And if it stays above 20 for a long time, I'm talking like a week, another week. I know you're thinking that's not a long time, but in the VIX world, that's a long time. Stays above 20, I think the market continues to stay weak. We're in a very strange time right now. The volume is very low. We're into the end of August. It's the end of the summer now. I feel so depressed when I say it's the end of the summer. I've got to tell you, I'm having such a nice summer. Depressing. I can't stand it when it gets dark out at like 5 o'clock, 4:45 at night in the winter. It's just, I truly can't stand it. Are you with me on that? Are you with me on that? Okay. So Let's take a look at the Russell 2000, down 1.22%. So by far, small cap stocks, the worst of the day. NASDAQ 100, the best of the day right there. So up 76 points. And that just goes to show you that technology had a really, really good day. All right. So let's take a look at a couple of other things. Why is the market down? I'm going to show you another screen over here. Okay. So Goldman Sachs cuts GDP forecast, saying the hit from the Delta variant is worse than expected. Okay. So I have been, on this, saying that so far, for a few weeks. I mean, I've been the last few days, the last week or so, I've been talking a lot about Delta variant. And for a while, it was looked at as like it's a minor regional thing in the southeastern part of the country, and we'll get through it. People smarten up, wear masks, slow the spread, and don't overwhelm the hospital system. That's the big thing, overwhelming the hospital system, because then you can't take care of the people who really get sick. It's really a worst case scenario now, and it's not just a regional thing. A lot of states, including Oregon and Hawaii, are loaded up to the gills with COVID Delta, and their ICU beds are taken up, and it's spreading around. Even where I live in Long Island, and in my community, we've got a very high percentage of people who are fully vaxxed, not just one jab, but the two jabs, and it's still around here. So we're all being very careful. But they cut their forecast, and their forecast they cut for the GDP for the third quarter to 5.5%. Let me see if you could see that. It's not rolling with the screen. Kind of stopped. Let me stop this sharing the screen for a second. Goldman Sachs cuts their GDP for Q3 from 9%. I have like a couple of screens around me, from 9% to 5.5%. That is a massive cut in GDP. I mean, 3 or 4 tenths of a % is a notable cut from Goldman Sachs to GDP. 1 full % is like a big deal, but from 9 to 5.5, it's cutting GDP estimates by more than a third. And Goldman Sachs, I respect a lot. I think we all do. That is a really big letdown for the economy. And what that basically says is what I said a while ago in the live stream, is that the reopening trade is, the reopening of the economy is now has been threatened. And I actually did a whole live stream about that. The thumbnail was, the variant is ruining the reopening. And it's not just like esoteric. It's not just a forecast. It's actually happening now. And it's really sad. It's just, it hurts the stocks, the reopening type stocks. And obviously, it hurts the economy. And we have to talk about how this is going to affect you, and what this means for your money, for your portfolio, and what you have to do to, prepare. Okay. I'm thinking about having an expert on the show who is an expert in negotiating a higher salary, and someone who's an expert at, interviewing. Because I think if you don't polish up these skills, a lot of you are going to be sorry. I was talking to somebody yesterday, and he gave me his new business card, and he's in another business, and I'm like, shocked. When did this happen? He's like, oh yeah, about 6 months ago. I was out of work for a year, and this is a guy in his he's older than me, so I'm 54. I think he's 56 or 58. It is really freaking hard out there to be over 50, get cut from a job. And this was a guy who's making a lot of money. This wasn't like just like a salaried employee. This is a very successful person in commercial real estate. But when you get cut at a certain age, it's tough to bounce back. And I hate to say it, but you might not be as desirable in the workforce. That's one of the reasons why I'm so glad that I own my own business, because looking forward, when I was in my 30s, when I started my own business, um, I always knew that that happens to people. I've seen it happen to people at the big firms, the big, investment firms, the big brokerage firms that I've worked at. I've seen that happen. And it was definitely something in the back of my mind that that'll help me, be owning my own firm will be a big help one day. So, but you never know. So you've got to keep your skills sharp. You've got to keep your network growing and be active in your network. The best time to build your network and to network with people and be active in your networking is before you need a new job. And a lot of people get laid off and they're all going, oh, I'm going to start networking and doing all these things. There's a million people before you who are already networked who are going to be picked over you because you just don't know anyone. It's not just necessarily it's who you know, not what you know. It's really about who you know, who trusts you because you've gotten to know people on a personal level. That's really what the networking is all about. So let's get back to the screen. Okay, it froze on me for a second. I really hate when that happens. So I'm just going to go back to screen one. Okay. And then the next thing is let's talk about Robinhood. All right. The Robinhood IPO. And this is another topic that I've been pretty much on top of. Okay. I did a whole live stream the day that the Robinhood IPO came out. I called it a failed IPO because it closed below its offering price. I still feel that way. And the stock was down 10% today. They came out with earnings after the close yesterday. Stock dropped 10% today. Um, and why? Because they basically said that in spite of massive revenue growth, the growth is slowing down. Remember, you pay up for a company who's not just growing quickly, but whose growth is accelerating. And these companies are so richly valued because of accelerating growth. They're priced for perfection. So when the growth is still there, but not as fast of a growth rate, that is enough to knock a stock on its keister. And as a result, stock was down $5, down to 44 and change, down from a high of 85. So it's something we've been talking about here. And my point was, what's so special about Robinhood? They're just another online brokerage firm. I mean, if Schwab was valued the same way Robinhood would be, Schwab would be worth, I don't know how much more, 5 times more value, 10 times more in value, a lot more though. Because Robinhood has a super high valuation on a relatively modest amount of assets under management. And yes, they do have a lot of accounts, but you want to compare the account size of a Robinhood to like a Schwab or an E-Trade or an Ameritrade, not even close. Robinhood is really small compared to those, but it's become a meme stock. We're going to take a look at the meme stocks now. Okay. So let's go back to sharing the screen. All right. And man, just so much action in the market today, but let's take a look at the meme stocks. Incidentally, I have a list of meme stocks and it's actually called my meme stock list. Okay. So let's bump it up here. Meme stocks. Okay. AMC down to 33, down another $2.73. It was up to 30. The high on it was 72. Okay. See that over here? 72. And that is, that is not AMC to the moon. That's not diamond handing, diamond holding the stock. GameStop down to 152 from 483. Now, granted, if you got in any of these stocks early enough, you have nothing to complain about. But remember what I showed you last week when we looked at charts and they go parabolic, like straight up, like an AMC, GameStop. Okay. It's that parabolic chart that pulls people into the stock, that attracts a massive amount of buyers who want to jump on the bandwagon. And those are the people who always get left holding the bag, not the people, obviously, that got in very early. And now a lot of people are sitting there with down stocks thinking, market's up, we're in a bull market, but I've just given back like all my gains for the last 3 years because I took a shot in these stocks. And it's a shame that people don't know how to invest. I'm not saying don't take a shot on something if you believe in it. But if you're taking a shot on something just because it's going up, because you're playing the greater fool theory, I'm not calling you a fool. What I'm saying is if you're playing the greater fool theory, that just means you're buying something strictly because you believe you can sell it to the next person at a higher price. Has nothing to do with fundamentals, has nothing to do with any financial metrics. You just it's in a hot trend, you're going to buy it and sell it to someone else real quick, and you're playing the hot potato game. Look at Clover. Clover was 85. No, I'm sorry. Clover was up to 28, down to 7. Wendy's, I mean, of a meme stock, Wendy's is to me, Wendy's and Bed Bath & Beyond are the real companies. But, at least Bed Bath & Beyond, it's a real company, but it was up to 54 almost, down to 25. These stocks have gotten shellacked. I mean, just absolutely crushed. So let's take a look at another place because, the NASDAQ 100 did pretty well, and we want to make sure we understand why, okay? And that's why. Remember I said techs must have obviously have done well if the NASDAQ 100 is a good, strong performer, especially compared to the NASDAQ. XLK, these are the ETFs that track the 11 sectors of the stock market, okay? XLK covers technology, up almost 1%, nice rebound from what's been happening lately. Real estate up a little, consumer staples up a little, utilities up. Who is down? Industrials, financials, building materials. Look, the bottom 4, industrials, financials, materials, and energy. The economically sensitive stocks. But we keep flipping back and forth between this. And this is always why I say I want you to diversify and not just hold tech stocks. This is how people got into so much trouble in the year 2000 when the tech bubble blew up. People thought tech stocks were a can't miss sector. And when the what hit the fan, it was a big time can't miss. It was a big time can miss sector. And diversification, as you know, it's a strategy that reduces risk. It's not a strategy that enhances return. If you want to enhance return, you have less diversification and you concentrate your money into fewer positions. But diversification, as important as I think it is, I think you agree it's important. It's a strategy that reduces risk, but it doesn't necessarily protect your portfolio from a down market. When somebody says, "Oh, I'm very diversified," you say, "Oh, I'm not worried about the market. Whatever the market does, I'm very diversified." So what? Who gives an F? You're diversified, so does that mean your account won't go down? No. Don't overplay the benefits of diversification when it comes to thinking your portfolio is protected when the market goes down. When the market goes down, you're going down with it. Okay, if you're not diversified, you're in that one stock that went up when the market goes down, good for you, but then you're not really diversified, and that's a whole other story. Okay, so financials, building materials, energy down. And this is what's going on right now. So here is the deal. Well, Jack had a comment. Yes, sure sounds good for lunch. And I'm sorry, Jack. I've been meaning to reach out to you. Just when the COVID thing started, just life has these twists and turns. We'll talk. We already do talk. What the heck was I saying? Oh yeah. So we've been talking about the variant. The other thing is the taper tantrum. The Fed tapering. Well, we've been doing this for 24 minutes. I'm just getting into the taper now, but I talk about this taper every day. So here's the deal with the taper. Got my Dunkin' Donuts large iced coffee. What do you prefer for iced coffee? Dunkin' or Starbucks? Let me know in the comments. I prefer Dunkin' by far. So when the Federal Reserve has been buying $120 billion worth of bonds to pump money into the banking system, okay? And we're going to do that in September. Right. So the Federal Reserve pumps money into the banking system every month in the amount of $120 billion. Now, they buy $120 billion of bonds. That money presumably makes its way into the economy, keeps money easy, access to credit, keeps long-term interest rates low. So the Fed buys $40 billion of mortgage bonds and $80 billion of Treasury securities. Long-term stuff keeps yields low. Okay? I'm not talking about short-term rates like the federal funds rate or the discount rate. I'm talking longer-term yields. That's why one of the reasons why the 10-year Treasury is so low. And I've been saying this for a while. I think it's time for the Fed to stop. The Fed. We have a strong reopening, economy's booming, people are being hired. There's a shortage of labor. There's inflation. So if the Fed stimulates the economy too much, it drives inflation up. But all of a sudden, we're finally at the point we're getting what we wanted. We wanted the Fed to cut back, right? So we wanted this is good. We wanted the Fed to cut back on the tapering. I mean, on the bond purchases, because it's going to create too much inflation. But all of a sudden, because of the Delta variant, it's throwing things into chaos. And now the reopening is questioned. Over 90% of all counties in the United States are now in a high risk zone, a red zone. I show you that map once in a while. Okay, CDC map. And now, we're finally at the point where the Federal Reserve, their minutes came out yesterday from their July meeting. The Fed meets like 8 times a year. From their July meeting, regardless, it's 8 or 10, but regardless, the Fed showed in its minutes from its July FOMC meeting, Federal Open Market Committee, the FOMC, Federal Open Market Committee. Okay, they decided that they are really talking about tapering, slowing that $120 billion or scaling it back to maybe, $110 billion, then $100 billion. And they're talking about doing it over about a 10-month time frame. And they're actually very seriously considering starting to taper this year in 2021, by the end of the year. And a lot of people have already had a lot of bravado saying, it's time for them to start tapering. I'm one of those people who said it's time for the Fed to start tapering. It's one thing to say, you'll be brave in the fight. It's another thing to get into the fight and still be brave, right? So it's one thing to be brave about the taper, but when we're really about to do it, a lot of investors are going to get a little skittish, take a deep breath and say, you know what? I've made a lot of money in the market. I'm going to take some chips off the table ahead of this. I'm worried about it. I'm going to take money out of the market and just go to cash. And that's what a lot of investors are doing. But it's particularly frightening now. Not frightening. I think it's spooking investors right now because they're doing it now when the COVID variant, the Delta variant, is skyrocketing in the number of cases, hospitalizations, and deaths. And so now a lot of people thinking, wait a minute, maybe we shouldn't do this right now. Maybe it's too soon. Maybe we need to not do the taper now. So we're really going from the economy is strong enough to handle the taper to, wait a minute, because of the Delta variant, maybe now the economy isn't as strong as we thought. And that's where I brought up to you how Goldman Sachs cut their GDP for the third quarter from 9% estimate to 5.5%, which is a huge, huge cut for them to cut their estimate of GDP growth. It's it's remarkable. I just want you to know that is a remarkably large cut to GDP estimates from Goldman Sachs. So that's what's happening. It's wreaking havoc on people's portfolios. So what do you do? Well, the market, for the most part, was up to, the Dow was off a little bit, but a lot of stocks are up today. Tech was up today. So I'm going to just say what I've been saying all along. You want to continue to own the work from home, stay at home stocks. You also want to own reopening stocks, economically sensitive stocks. You want to own them both. Don't try to play this one way or another because I just don't think you'll be able to time it. Because at any given time, we're strong on the reopening, we're high and mighty in the reopening, then we're high and mighty on an economy closing. But we've got to own those stocks that allow us to work from home and stay at home, like the DoorDashes of the world, the DocuSigns of the world, the Zooms of the world. And then all of a sudden, we're into the bank stocks of and people think we should be in Caterpillar and Chevron, and it's wreaking havoc on people's portfolios. And this is why, if you can't take it from the individual stocks, you certainly could invest using exchange traded funds. I'm not even going to talk about mutual funds. I don't even get into those. I'm really just more interested in exchange traded funds for a number of reasons, and that would be a good way for you to go as well. So I don't want you making moves on what's happening with Delta, and then we're high and mighty in the economy, then we're negative in the economy because Delta. Then we have to worry about the taper. I think a lot of this is noise. Now, if you want to take a look at the taper and seriously say, I want to see what our time is. If you want to take a look at the taper and say, you know what, we have had all of the stimulus pumped into the economy, and the growth in the amount of dollars that have been printed since the Great Recession has been so enormous that is what has pumped up the U.S. stock market. I know a lot of people will say that it's all stimulus, it's all the Fed stimulus and fiscal stimulus. Well, there have also been a lot of buybacks in the stock market. Just now, we're seeing a lot of new supply with SPACs and IPOs hitting the market. But for the most part, the stock market is incredibly shrunken down over the last 10, 12 years. And if the market does have a 10 or 20% hit, people will say, yeah, you take the stimulus away, the market's not worth anything. Look, we could have a big correction at any given time for reasons that we don't even understand until quite a bit of time passes. What I'm saying is, it's not, in my opinion, it's not all stimulus. And I think once we get past this taper tantrum, we'll be okay and we'll start marching higher. A bigger worry to me is interest rates. If interest rates go up, long-term rates go up meaningfully because the Fed's not leaning on bond yields by buying them. If the Fed buys bonds, it drives interest rates lower. That could have an impact on your high PE ratio stocks, a lot of your high PE ratio technology stocks. Price over earnings is your PE ratio. It's just a ratio that we use to value stocks, compare stocks to other stocks, but it's not necessarily the only valuation metric that you should use. In fact, it's not like the first thing I look at when I look at a stock. A high PE ratio or a low PE ratio does not really move the ball for me in terms of making an investment decision. It's more growth or assets as opposed to just, it's got a PE ratio of 5 or a PE ratio of 50. High PE ratio doesn't mean a stock can't go up. Amazon is always the best example of that. And a low PE ratio doesn't mean a stock is cheap and it can't go down. Take a look at the performance over the last 10 years of GE, for example. Anyway, that's my story. I'm sticking to it. Happy Thursday. I don't stream on Fridays, but if you have any questions for me, hit me up in the comments, send me a DM, give me a call. My office number, 631-920-6622. I love hearing from you, and I'll be back with a brand new episode on Monday. All right? I'll see you soon. Have a great weekend. Thanks again. Bye.